What's up, everybody? Michael Silva here. I can't believe this. I am sick again. Back to back to back. I can't get over this dang cold, so my voice is a little off. But nonetheless, we gotta do a stock market brief. It's gonna be May, people. And you know what the saying goes in May? Sell in May and go away, as there's typically a lot of volatility when it comes to seasonality. We're going to talk about that, and we're even going to do a deep dive. For anybody that's out there that's not in the Discord or the Patreon group, I'm going to be showing you a little bit more stuff that goes on in there, giving you the monthly expected moves, weekly expected moves. I'm going to give you some zones too as well. We got a lot to discuss on today's episode, including a lot of good charts to go over. So let's just go ahead and get right into it. Well, welcome back, everybody. So yes, the saying as it goes is sell in May and go away, and we're approaching May. Yes, it's April 30th. The new start of the month is going to be obviously May when Monday comes around the corner. And you can see we typically get some sell-offs into May. We get a little bit of more of a rip-off. This is based off of seasonality. And then we pull back down in June, right? However, it's kind of hard to believe that we're going to be selling off given the current run in price action pretty much in 2023. Now, this is looking at the SPY. It's not doing nearly as well as the NASDAQ 100, but it is being held up mainly because of the names that are in the NASDAQ 100. Now, I put this out on Twitter. If I had to make a random prediction on if or when there will be red weeks for the SPY in May, I would say weeks 2 and 3. Follow me for more incredibly useless predictions. Now, there's a reason why I tweeted this. It's just data dating back about 20 years, looking at a week-to-date weekly performance in the S&P 500. Now, the last week, right, was week 17. So give it up, right? 2023 here, week 17 goes to the bulls. But guess what? There was a 70% probability that it ends in reds or in green. So over the last 19 years, week 17 was green 70% of the time. And you could see that we were pretty much red, and then we closed at the high of the week. Now, this is why it gets a little interesting where it says sell in May and go away. You can see the probabilities here in May, week 19 and 20. Those are weeks 2 and 3. 37% of the time, you typically have green weeks for those periods in time. This is dating back, right, 19 years worth of data. Week 1 is what we're coming into, and there's a 58% probability that it's a green week. So this is just some seasonality stuff. Take it with a grain of salt, but there are other important factors that we need to be made aware of, right? So seasonality is a reason to potentially be aware, but then also if we just take a look at a couple other macro data points, you can see the Fed's balance sheet here, right? We saw this big run up, right? This was during the banking crisis, and what happened here was, well, the S&P 500 reacted quite positively. It started moving up. However, what I want to call out is now it is starting to tighten back up again. Now, as we've been tightening off, and then it took one quick shot to basically, remove half of that, we are starting to tighten back down. And this, like I said, when you start tightening here, you typically get more volatility in the S&P 500. But that's not the only chart that's interesting. This one was brought to my attention by Sven Henrik, and you can see the red line. That's the S&P 500. And then you have other factors draining reserve balances. So think of this as just liquidity. And you can see the S&P 500, right? We've seen run-ups like this. We've seen run-ups like this. And during these times of, for example, like right here, the S&P 500 had this nice big bear market rally. But what did we see over here taking place in other factors draining reserve balances? Well, this started to taper off. And that divergence, right, these are pretty strong correlations. They typically tends to follow this, at least since this 2022. And why I'm calling this out now more specifically is because the S&P 500 is ramping up higher right there at that yearly high, while this is starting to take a nosedive, saying liquidity's coming out. And that right there is a little bit of a red flag and could really give us some insight into potentially, hey, we have even a stronger probability that we might have some red weeks in the month of May. But that's not it, people. We got a lot of macro information coming out, and the market has been highly dependent on macro data. So what do we have going on here, and how do we perceive this information? Well, first, Monday starts it off with ISM manufacturing PMI. We got JOLTS data on Tuesday. Wednesday is going to be the Fed interest rate decision and ISM services PMI. Now, on the Fed interest rate decision, this is going to be pretty important to pay attention to what Powell actually has to say, because the market could perceive it in a couple of ways. First and foremost, the market's already saying that there's about an 84% probability that we are going to be getting another rate hike. But what happens if Powell says, now we're going to start pausing and seeing how things happen? Well, the market might potentially perceive that as good news, where we get some sort of a rally, and that could potentially lean into why we see a stronger probability on the first week potentially being green. But it really depends on what Powell says. Now, on the last meeting, he said the base case, right, this is a quote from him, was to not start reducing rates. It's to hold it higher for longer into this year. Now, right, now it's the Fed for the Fed interest rate decision, right? We're looking at a 25 basis point hike. Thursday, we have balance of trade. And then Friday, we have more jobs data, which we know has a large effect on the overall tape, which means the market responds to that type of data. And it could be both positive and it could be both negative. But let's keep continuing down this road. We're in earnings season, so we have some big earnings taking place, of which is Pfizer, Ford, AMD, Starbucks. We have Apple, CVS, right? These are some of the ones that are in the S&P 100 that aren't all listed on that screen, but these are the ones that are reporting next week that are all in the S&P 100. Now, I just went over a lot, right? We have a lot of macro data. We have a lot of earnings. Well, this last month of April, we had a lot of earnings. We had a lot of macro data. And what did the S&P 500 do? We're looking at the E-minis. You can see that it didn't do anything for the month of April. It actually broke this 4,100 level, opening the door really to go a lot lower. It was a very scary move. But we did call out the possibility of a potential bounce there on the Twitter thread. And the reason for it was a couple of things. We saw internals showing positive divergences, and we saw overextended levels. Now, to which this rally came was much more aggressive. Now, what I can call out here that I find important is that we're still within the 100-point range between 4,100 and 4,200. But in recent days, these last 4 trading days, notice the range of the candles. The candles are starting to get a lot larger, telling us volatility from a day-to-day basis is increasing. And this is very important because we could be gearing up for a stronger move, where if we break substantially from 4,200, that could open the door to around 4,300. But don't be surprised if we get a little bit of a bull trap here and we get sucked right back down into this lower area. It's a very binary environment that's taking place, and we need to be aware from both a bullish and bearish perspective. Now, we talked about seasonality. It's typically quite volatile. This is where you see a stronger possibility of red weeks. If we take a look at the summation index for the NYSE, it started to give us an identification. It started to identify a potential change in trend, and it's starting to flatten out here. So maybe this could be a whipsaw, or maybe it is still identifying a potential change in trend here. If you look at the NASDAQ summation index, it's also identified a potential change in trend as the market has continued to press higher. We also have a negative divergence forming there on the NASDAQ McClellan oscillator. If I bring up this chart, this is looking at the Qs above us and the QQQJs, this is a good, typically these have a very strong correlation. Now, if you don't know what the QQQJs are, this is the next gen ETF, but if you go ahead and research it, Google if you want to look into it. But from what I've seen is there's a very tight correlation, but sometimes when the divergences take place, we can potentially get changes in trend as well. So you, for example, this is both from a positive and negative perspective, but if you look at the Qs down here, right, we're hitting matching lows down here from the 260 area, but what were the internals telling us, right? The other stocks, the other internal stocks, those were showing us higher lows, which is a positive sign. And you could see right when 2023 came, the Qs started to rip higher. So it showed us that, hey, the internals, right, a lot of the other stocks are showing strength, while the Qs are really, the top, 10 stocks or so are all mega cap names. So that was a positive thing. But if you date back even further and going into 2022 where the bear market started, you see the Qs actually had a matching top right here. And then the internals was showing us, hey, actually a lot of stocks are actually getting weaker. So breadth is weakening here. And that actually kicked off the start of the bear market rally. We have some other divergences in here too as well, but I wanted to just call out where we stand now. This could be a potential opportunity to rip higher. We don't know, but it is a divergence worth watching, right? We could easily break back up and then all things are well, or this is giving us insight into a weaker market, at least in the Qs. Well, that's not it. Take a look at equal weight S&P 500 up top and the S&P 500 below, which is S&P 500 below. It is a cap weighted index. So the top names, right? Google, Microsoft, Amazon, so forth. those are what's really been holding up this market. And you could see the divergence that's taking place where we're not near this high in equal weight, but yet we're matching highs right now in the S&P 500. Okay, you can also look at the value line geometric index, where I pointed out a divergence earlier where we have lower highs there while the S&P 500 is pressing higher. And we've seen that here before. We've seen that here before in the start of 2022. And we also see times where it's positive divergence where we get some sort of rallies. If you take it another step further, you can look at the percent of stocks above the 50-day moving average. We only have 58% of the stocks above it in the S&P 500, okay? And you can see the S&P 500 is right around a yearly high. And then the S&P percent of stocks above the 200-day moving average is about 58% too. So as we have matching highs here in the S&P 500, you can see, though, actually we have less stocks that are above the 50 and 200-day moving average. And that right there is just telling us, hey, this is some poor breadth in the overall market. Okay, if we continue on, we can look at something like Dow theory. This is the Dow Jones Composite. Now, the Dow Jones Composite average is built up of, well, three areas: the industrials, the transports, and the utilities. And the only thing actually up right now, you can see we have a lower high in the Dow Jones Composite. The industrials is what's actually holding things up right now, where you can look at something like transports. It has a significant lower high, and you see utilities as well has a lower high. So there is a clear divergence, saying to be a little careful here, especially that transports have been really taking it on the chin. We're seeing a little bit of a reflexive bounce here, but if this starts turning back down, that could spell obviously bad news for the industrials and even the composite. Now, if we take a look at something like back month versus front month volatility, we're now at a whopping 1.24 level, which tells us 24%. Basically, back month volatility is 24% above front month. So VIX is continuing to get crushed. It's at a new low for the year. I believe it was at the 15 handle, if I remember correctly. Absolutely bonkers. But this has marked tops in this bear market rallies, where we've seen actually right here when we called it out and we saw the market sell off a little bit. And now we're back up there again after the last couple of trading days. We saw the same thing here. We saw the same thing here. And we saw the same thing over there too as well. Now, this is a story of bad breath. And I think this chart really depicts that. This is a heat map of year-to-date performance, and this is where you see things like Apple is up 30%, Microsoft's up 30%, Google, Meta's up almost 100%, Tesla 33%, Amazon, and this is on a year-to-date basis. But if you look, if you just look at this right here, the mega caps, and then you take a look at all the breadth underneath the surface, you're seeing a lot of red or names that aren't up nearly as much, telling us that, hey, we just need to be aware that there are very few names holding up the market. And if these things start to consolidate or pull back, that's going to not be positive for the overall market. Okay, now it's time to get into some of the other stuff and get into like the S&P 500 on the 15-minute time frames. But first, I want to first show you this right here is the Discord that I have. If you want to access the Discord, you can go to the Patreon link right below. It's only $9 a month, and I'm about to show you how much we do for that $9 a month. Or you can save 60%, just do it annually. It ends up being $90, and then you get a full year into this. Now, one thing that I'm not going to be sharing is the trade ideas, all the charts. Maybe once in a while I'll bring those in, but I'm going to be showing quite a bit of stuff, such as the monthly, the weekly. I'm going to show some zones and the daily expected moves there too as well. This also, you get access to the community where they share a bunch of stuff there too as well. So let's get into it. Monthly expected moves. Now, I share also the charts here, but if you want to screenshot this, this is going to give you a good idea as what the options market is pricing in as forward-looking risk for the next month, the month of May, right? It's going to be May. I had to scroll back a little bit to get there. So if you want to screenshot this, this is giving you the products such as ES, NQ, or Ruddy, right? SPY, Q, IDM, and SPX. The ones that are going to be more accurate, in my opinion, are going to be these numbers, the ES, NQ, and Ruddy. So if you are paying attention to these levels where you say, okay, S&P 500, it gets up to 4343, in a very short period of time, I'd be hesitant to really press the long, right? But maybe if you're like, hey, I'm going to play long for this month, this could be a potential good level to take some profits. Vice versa, if you're like, hey, what if we fall down to 40.37 early on in this month? Well, this could be a potential area where you want to take profits or cover some if you're short, or potentially look to add into a position if you believe that we are on a projection to go higher in the overall S&P 500. And this is how you can visually look at it. Where you can see right here, this thin dashed line, the thin dashed line is the monthly expected move. So this can take us to where? It could take us up to this previous high just above that 4,300. And you can see here on this chart specifically, we're above this red shaded area. The red shaded area is bear market territory, and that's measuring from here to minus 20% below. So you can see just under 3,900 is where bear market territory really is. You can see on the month, overall, we finished up 1.46%, and that really was the last couple of days of the week. That brought us back up there, breaking out of this kind of consolidation area over here. We have the PPO starting to curl itself over there too as well. So we're going to continue to watch this. The 5-period monthly moving average held as an area of support. So if we start breaking down through the monthly low, be very careful in that case. That would be 40.50 to round it off there. 40.50 would be the level. If we start breaking down that could be pretty bearish for the S&P 500. If we take a look at the Qs is actually still in bear market territory, but it is trying to get itself out of it. This is a little bit of a hanging man type candle. So we'll see here if we start taking out the low, that can also be bad, but that's also right about the lower monthly expected move. Okay. If we take a look at the IWM, and oh, by the way, it only finished up 0.5%, right? So the Qs came back the last couple of days, 0.5% on the entire month, despite all the earnings, despite all the macro data drops. That's where we finished off. The PPO is also starting to curl over there too as well. Now the IWM, good barometer of the overall market and economy, we finished down 1.79%, coming off the lows a little bit, but you can see it's a different story. We're below that monthly 5 EMA, and that is declining, and we're in the red shaded area, which is measuring 20% from the peak to down here, right here. So we're far from that level as well. I didn't explain what the dashed lines are, but the dashed lines are actually the quarterly expected move, which we have obviously more time in the quarter left. Okay. Now, let's go on to the weekly expected moves. I'm going to share the entire list here. These are the products that I track, that I share within the Discord too as well, and I update these weekly. Obviously, these monthly ones are updated monthly. The quarterly is updated quarterly. The weekly is updated weekly. So these are the products that I track. It has some of the big megas in there where you can see the weekly expected moves, right? So Netflix, for example, it has about an $11 expected move. Look at NVIDIA, the amount of volatility in NVIDIA, right? Plus or minus $10 is the expected move. These are the levels to obviously pay attention to. I also included 2 sigma, right? If you think of this as a bell curve, if you think of expected moves as a bell curve, 68% of the time, right? 68% of the time, this is the bell curve monster. 68% of the time, it finishes within the upper and the lower expected move. But remember, there's 2 sigma moves, and there's even a stronger probability that it fits within, obviously, those levels. But these are the upper and lower levels of a 2 sigma move if it were to move like that. Now, if we take a look at the expected moves for the daily, this is something that I now update daily. We included that into this Discord channel as well. The ES, the NQ, the Ruddy, the SPY, Qs, IWM I put in there when they have daily expiration. Sometimes they don't. And then the S&P 500 too. So these are going to be the upper levels going into Monday, the lower levels going into Monday, and these are the 2 sigma levels. So let's hop now into the 15-minute time frame. This is where I get a really good gauge as to saying, hey, are we overbought from a short term? Are we bullish? Are we bearish? So as it stands, a very quick way to say, hey, is price action bullish or bearish? Are we above the 5-day moving average? Answer is yes. So check 1 to the bulls. Now, I also looked at, okay, where did price come from? Well, price was down here, and now it's up here, and it pretty much moved in vertical fashion. So would it be smart to go long right here? No, in my opinion, not. If you do that long enough, you're going to get sideswiped, and it's going to come down, and you're going to get stuck in a position. So in my opinion, this is where you wait for things to consolidate. Now, does that mean you can't get lucky and just open the day up at 418.72? Absolutely, that's a possibility. All right, but you need to play consistency. Consistency is the key if you want longevity in the markets. You can't just always be FOMOing into rallies. You need to wait for consolidations or wait for pullbacks to get more, just better entries in the overall for better risk to reward setups. Okay, now a couple other things I want to call out. RSI, negative divergence, right? So we have higher highs, we have lower highs in the RSI. So that is telling me that, hey, we're pretty extended from the 5 DMA. It's pretty much neutral overall, right? Flat. It's not really inclining, but it's starting to pick back up. So if we start getting hit back to the downside around 413.14 and the 5 DMA is starting to pick itself back up, this could be a potential area to buy the dip if you want to play a trend move up into the upper weekly expected move. Okay, but like I said, overall, a little bit too far and fast. Negative divergence in the RSI. As far as the weekly expected moves go, those are those right there. And then the daily are right there. Now, if we take a look at the Qs, very same situation. Negative divergence, right? We have a high, a higher high. We have a high and a lower high there. Pretty extended from the 5-DMA. What I found interesting here was price started breaking down, and look where it opened up at. Okay, so it couldn't do this during the cash market session. It has to do it overnight, saying, hey, we got to open back above that 5-DMA, and boom, we started moving a lot higher. So overall, this is a very neutral stance, despite seeing that it broke out of here. We have a lot of volume that was traded in here, so don't be surprised if we pull back, and then we try to start to make another ascend. Now, if we start pulling back, you can potentially do an early entry. If we start taking out this low, be a little bit more careful, because it would probably try to come down to test this 5-DMA, potentially even this lower weekly expected move. Once again, this is not an area where I'd chase. I'd look for pullbacks, because pullbacks to potentially buy, given the context of how this stands above the 5-DMA. When I have the week start off, what I want to pay attention to is the daily expected anchored VWAP, the monthly anchored VWAP, and the week to date, which is all going to be the same anchored VWAP starting tomorrow, because tomorrow is the start of the week, start of the month, start of the day. I also share zones, okay? So the zones are updated daily, and this gives a good idea of things that are overbought and oversold, okay? And I have it set up where you can see the low end. You can think of it as advanced Bollinger Bands. Okay, a low here, a high here. If you want to really know more about this, right, this is based off of, this indicator is based off of the book Misbehavior of Markets, originally coded by Joe Catt. And it's a highly effective, but the way that I'm using it is I just extract bulk data and I apply it over a bunch of different assets, including all of these sectors over here. I do S&P 100, I do volatility, I do currencies, I do commodities, I do global ETFs, I do China equities, I do miners now, I do a bunch of different other stuff. And if I take a look here, what I'm noticing here is obviously you have a low, a midpoint of the indicator, and a high. But then I have this range, like where is it located within the range of this zone? And this right here, it's color coded. So if I draw this out, you have a high, you have a low, and you have a midpoint. If price is reaching up and is turning red, it's telling me that price is more north of the upper band, okay? And that's where you want to be a little bit more cautious, right? If you're bullish the S&P 500, you don't really want to buy it at the high end. You want it to buy it at the low end if you're bullish, right? If it's if it's in a bullish trend and you buy it down at the low end, it's just showing you a good opportunity to potentially buy on red and then sell, obviously, some on green. Okay, so where are we at now? Clearly, it's showing us that as far as this indicator goes, we have about a 0.53% to the upside, and then we have about a 2.5% to the downside. Meanwhile, if you take a look at the VIX is at the lower end. Now, if you go back just a few days ago, I was showing you this, and this was before the bounce, right? I did it on the Twitter thread. The VIX was red, okay? The VIX was red. The S&P 500 was green. We saw the positive divergences. Now we're seeing the flip, right? We have a negative divergence on the RSI in the 15-minute time frame. We have a red period of the SPX in the higher end of the range of its zone. And then we have the volatility showing us at the lower range. And you see a lot of products are starting to light up red here. If you take a look at the S&P 100, we've been talking about poor breath. Well, that's because the big names that are reporting earnings was perceived as good, right? You can see that they're hitting up at those higher levels of their range. Like I said, a volatility as well. You're getting not just the VIX, but you have stuff like, so VIX, we have RVX, Russell volatility, NASDAQ volatility, and so forth too, lighting up red. And even, VVIX is in the gray, so it's below the midpoint, but it is not quite to the low end. But you can see gold volatility is north towards its low end there too as well. So just to recap about this May stuff, yes, it does tell us that basically seasonality perspective, we do see weakness. We see liquidity starting to drain. We have a lot of macro data reports to come out. We have the Fed interest rate decision and a lot of earnings. Overall, we've been going sideways. We're starting to build out a lot of divergences overall, including in Dow theory. Back month is starting to fire off way above front month volatility, and we have overall poor breadth in the markets. So where does this lead us? It leads us to be incredibly cautious. Price is what we obviously can make money off of, and it's currently telling us, hey, we're above that 5-day, it's starting to curl over, it's bullish, but you just don't want to FOMO here. You need to be very tight with risk, and you got to be very careful here because it can get quite volatile. That's all I got for you, everybody. See you later.